Hi, everybody. Welcome to the Navigator series put on by Salus GRC. I'm Nick Birdman. I work here at Salus GRC as a director, and I am joined by my two co-panelists, Karen and Aaron, who I will introduce in a moment. Today's topic is common SEC deficiencies, and we are excited to get started. We have a really great panel today. Aaron has worked as a securities lawyer at the SEC, rising to the level of branch chief in the chief counsel's office for the Division of Investment Management. And he's also worked at various law firms. Currently, Aaron is a partner at Latham and Watkins in Washington, D.C. Welcome, Aaron. And Karen worked as a securities lawyer at the SEC as well. She's also worked in-house at multiple law firms and in-house at multiple registered investment advisors. She was a senior compliance officer at Millennium Management and was most recently the chief compliance officer at Zeiss Group, LLC. Welcome, Karen, and we're really excited to have you.
Thank you.
Just going through the agenda quickly. We'll talk about how to prepare before exam letters come and how to interact with the SEC during your exam. Then we'll go over a pretty solid list of common SEC deficiencies with some tips and tricks along the way about how you can avoid them. And lastly, we will open it up for questions with any remaining time we have. We wanted to kick this off with a polling question about whether you've personally facilitated an SEC exam recently or whether you have never done so. We'll give everybody some time to answer this question before we get going. And just so you know, all of these polling questions are anonymous, so nobody will know how you answer. I see that we have some good numbers coming in. We'll give it another few seconds before we move on. It looks like we have about half of everyone on here, so I think we will reveal the answers. Wow. It seems like a pretty big chunk of the audience hasn't been through an SEC exam before.
And that's interesting because typically, you get examined as a new advisor within your first 2 years, and then on a recurring basis. So I do find that interesting.
Yeah. And I think if we take the, never have gone through an exam and the 5 years together, I think we got a lot of exams coming up in the near future, Aaron. I think, maybe Karen, I can let you sort of set the table about, before the exam letter comes, what we should be thinking about. I think you might be on mute, Karen.
Am I still muted?
Nope, now you're good.
Okay, then. Hello, everybody. Well, apologies for my protector dog. If you have not yet had the pleasure of facilitating an exam, let's start at the beginning. If you get an exam letter today, and you are now for the first time thinking about how to avoid the deficiencies, you're probably too late in a pretty significant way. At this point, your best hope is to facilitate the daylights out of that exam and get as much credit with the examiners as you can. Because the time to be thinking about exam deficiencies is the day you begin building your compliance program. So put another way, the best way to avoid deficiencies is to custom tailor your compliance program so that it is woven into your day-to-day operational functionality. Compliance has to be baked in, and it has to align fully with how the business is actually being done. You'll also need regular training. So everyone, including and up through senior management, knows what the policies and procedures are that affect their work, how they function, and why those policies and procedures are in the program. You're going to need effective monitoring so that you can identify potential breaches. And finally, when the worst happens and you confirm a breach, you must enforce your program without fear or favor. No one is too important to the firm or the bottom line to be immune from discipline. So having said that, most of us are probably pretty well past the initial development of our program. So what do we do now? Well, look, to start with, it's never too late to go back over your policies and procedures and your monitoring and your reporting capabilities. So start by taking a good look at your compliance manual and actually take the time to read it rather than skim through it. Does anything you see sound a little bit more like a legal treatise than like clearly defined policies and procedures with specific responsibilities set out? And here your red flag is going to be anything in the passive voice. Anything that says X will be done without saying who's going to do it and how often they're going to do it and how they're going to document what they do is at risk for either not being done by anyone or not being done properly. Also, when you do your annual review testing, it's really tempting to want to get good scores. But please do everything you can to avoid that temptation. Don't adopt a regular cycle that is rigidly followed from period to period, and don't rely on random testing topics. If you really want to get out in front of issues in your firm, think about what's worrying you. Who do you think might be cutting corners? Who do you think might be sloppy? Look for those issues. Look for the policies and procedures that you've tried to look at and just can't quite get your hands around. It may feel counterintuitive to go looking for trouble, but in fact, if you are lucky, you will find those small discrepancies, the small implementation glitches that can result in undetected problems. Why are you lucky to find that? Because the best thing you can do is find those problems and fix them before a regulator comes in and finds them for you. So why is that a problem? It isn't just that you don't want deficiencies. It's that if you have a deficiency, you may wind up with a recommendation from the staff that's highly prescriptive and potentially just not that well suited to how your firm does business. If you find the problem yourself, you have the luxury of defining a procedure that is both effective and efficient given your firm's operations. You're going to know those operations way better than a staff examiner can possibly know them.
And Karen, on that point, I will say, I think the staff does give credit when they see someone going in and policing themselves and actually going in and making improvements. That's a sign of a good, robust compliance culture.
Indeed. And along that line, while it's a very healthy road to start down, you want to make sure your top management knows this is your approach so that there are no surprises when your self-testing reports identify issues. Nobody in management likes a surprise. So every issue you can solve before it turns into an exam deficiency is a way to save your firm time, you save money, and most importantly, you save management attention and reputation. That is a key part of your value proposition as a compliance officer. After that, you want to start going back over all the Department of Examinations risk alert and all the enforcement division enforcement actions, especially any of the risk alerts that focus on frequently found deficiencies. There's a really good shot that if others in your sector are experiencing a problem, that your time will be well spent to go take a look at that in your own shop. And with that, back to Nick.
I was just going to jump in and say, I can't emphasize that enough, Karen. Looking at what the Division of Examinations is putting out there, that is a roadmap for all of us to be able to follow and get an idea of what is the SEC really focusing on here? What are they seeing? What do they care about? So if you have not looked at those, they're available on the SEC website. Strongly encourage you to look at that. Every year they put out an exam priorities document, which in this most recent year is interesting because there's been an administration change. So some of the areas in there might not be as salient or relevant today, but it still is an excellent resource for all of us to improve compliance.
Yeah, I totally agree. And before we hop into some of the common deficiencies, so we've gotten our exam letter. Maybe we've talked to the examiner, or we've taken the call. Do you guys have any advice on how we should be interacting with the staff?
Well, I'm going to step back even further. You want to make sure you can get your letter, because I have heard of clients out there who they don't keep their information up to date on the IAPD system or on the ADV, or they simply aren't checking their emails. What you don't want to start out with is an angry examiner wondering why you haven't responded to them. Typically, the turnaround times when you get that first letter are very fast. I would say 10 to 14 days is pretty standard. Although, Nick, I think you maybe mentioned you had one that was even tighter recently. But yeah, I want to step back and emphasize. Yeah, I really want to emphasize that point. Make sure your contact information is up to date so you get that letter and stay on top of it. And I'll step back there.
Yeah, I think. Sorry, go ahead, Karen.
Yeah, I can't emphasize enough how important candor is when you're dealing with the examiners. It is human nature not to want to get caught with a problem. And yet, it is so much better to come forward and identify any issues you're currently experiencing than to cross your fingers and hope the staff doesn't find them. First of all, I will tell you the quality of the staff has improved dramatically compared to when I was first starting out over 40 years ago now. I would say 15 to 20 years ago, there was a big effort mounted to find people for the exam staff who have been in the industry. So while you may not draw the long straw and get someone who totally understands your sector, you shouldn't count on them overlooking issues in your organization, whether they're within the scope of the exam letter or not. And the risk you take If you sit on your hands and hope they don't find it, is any problem you have that they find that you didn't tell them about will be perceived somewhere between two ends of the spectrum. One end of the spectrum is, gee, how competent is this chief compliance officer if they didn't even know about this issue? That's if you're lucky. If you're unlucky, the other end of the spectrum is, did they really think I wouldn't find this? What else are they hiding? And then the rest of the exam will become very adversarial. So my practice in the many years I have been in-house is when an examiner comes in, even if I'm still in the middle of investigating an issue, I use that exam opening meeting as in-house counsel or compliance officer, by the way. If you're a business person getting ready to facilitate an exam, do not try this without your lawyer or compliance person around. Tell them what's going on. Tell them what you found. Tell them that you're working on it. If you've engaged outside counsel, all the better. But even if you haven't, the fact that you have undertaken to scope the issue, get to the bottom of it, identify the root cause and fix it will go a pretty long way to overcome the fact of the problem, whatever it is.
In a real world story, I was recently counseling a client through an exam. And during the course of the document production, we uncovered an error in the way certain calculations were made. And we were proactive about it. The client went out to any affected investors, had a clear plan of attack on how to remedy this. And when the SEC came in, and Karen was referring to an on-site visit, I believe, the presentation, when the staff comes in, we brought it to their attention. And in the end, when the deficiency letter or the exit letter came out, it was just mentioned, and the corrective action was an improvement to policies and procedures, which in a situation like that, that is what you want. If you uncover something and just are proactive with the staff, it really goes a long way.
Yeah, I think sort of what everyone's saying is be communicative with the staff, right? If you're gonna, miss a production deadline as early as possible, reach out to them directly, ask them for another few days. They'll probably give it to you, but it's all about sort of communication with the staff. And just something I like to tell my clients is this isn't your adversary, right? Like the Department of Exams and the SEC is your regulator. So, let's treat them as that, right? And let's sort of work to get them what they need so that they can come in, make their determinations, and hopefully leave, right? And we don't want to treat them too adversarial as, just sort of sets a bad tone, I think, for the exam.
And I will say, when I went on exams, because I would shadow examiners as an IM staffer, we would go alongside them. I really appreciated when I was treated with respect and kindness, and that really went a long way towards building that rapport. And that is so helpful in getting through an exam. It really does go a long way. Being adversarial, there is a time and a place for that. But I think that's generally if things go much further down the road, and if you actually are on the cusp of being referred to enforcement, that's where the calculus changes. But during the course of the exam, the on-site visit, being kind goes a long way. I know that sounds not particularly profound, but it does have a lot of weight behind it during an exam.
I agree. Another way to think about it is when you are dealing with your regulator, you can ask for more time, but they're only going to give it to you if they're so inclined. Put another way, when you're not holding any of the power cards, there's no such thing as negotiating. At that point, you're begging. So be kind and it will come back.
And for what it's worth, I actually have never had them turn down a reasonable request for additional time. They have never said no. And by reasonable, I mean, you're not going out and saying we need 60 days. But if you need additional time, it is not uncommon for them to give you another week, sometimes 2 weeks if you really need it. Some of it will depend on the scope of the exam. I think they're going to be less likely to give you a lot of wiggle room on a new advisor exam where you don't have as much information to turn over necessarily. I think there's a little bit of a spectrum here in which they'll be accommodating more so or less so.
Yeah, I could say
makes sense if you are asking for more time to offer a role in production, not to say can't give you anything for 2 weeks. If you can't produce your compliance manual the day after you get the exam letter, then you have a bigger problem than this panel can help you with. The point is, do everything in your power to make clear that you are cooperating, to make clear you're not trying to hide anything, and to help them do their job. If you do that, they are going to be far more inclined to treat you with the same respect you show them.
Yeah, I was actually just going to make the rolling production point. And just a quick story that I had a client recently who got an SEC exam. They were at the same time undergoing NFA exam, and the productions overlapped. And so, we reached out to the SEC, told them what was going on, and of course they gave the client some more time for production. But we produced on a rolling basis, right? There was some overlap in the requests, so it made it a little simpler to do that. But yeah, I agree with Aaron's point that they tend to be pretty reasonable when faced with a reasonable request.
And that gets to, there are some good questions coming in. One of them is, what do you do if the deadline is coming up when you're going to be away for a week on vacation? That comes up a lot. I can't tell you how many times that has happened. Last summer, the SEC wanted to do an on-site when a principal was going to be out of the country on vacation. And we found that by being proactive, communicating in advance, that we were actually able to, get them to push that back in a time that was, more accommodating for our client. So I do think you can get that flexibility, but it has to be within reason. And if you explain the human component, for example, that our CFO is actually out of town on vacation, or our CFO has had a health incident, or something like that. If you humanize it and it's not unreasonable, they usually are going to be flexible.
Yeah, I agree. And I think before we go too far, maybe it's time to slide into a pretty long list, I think, of common deficiencies that we have. So
one thing I do want to just touch on before we get into the deficiencies is exams take a very long time. This is not a 1 week and you're done kind of thing. It can drag on for years. So that's an important point for those who have not been examined. I don't want to scare you. I think a smooth exam is probably 4 to 6 months, best case scenario in my experience.
Mm-hmm. That sounds about right.
Cool. So, I think back to Karen's very salient point about having policies and procedures that are reasonably tailored to your firm. I think that's probably, and you guys correct me if you disagree, but I think probably the most common deficiency that we see. And this is either that your policies and procedures don't reflect what you're actually doing, or it is that your policies and procedures don't accurately reflect what you're doing, or they don't reflect what you should be doing. And so I think having policies and procedures that are exactly that, reflect what your firm does and how your firm does it, is probably the most important thing that we can do as compliance officers.
Yeah, and I would note that that's an element or a component of almost every enforcement action you see is failure to follow compliance policies and procedures or them otherwise being deemed inadequate in the eyes of the SEC. But if you go through any enforcement action, there's a 90% chance you will see that as a piece of it. Even if it's a custody rule, enforcement action, there will have a violation in there usually.
Yeah, so just to give you an example of how that plays out frequently, when reading enforcement actions, failure to follow procedures, you're getting exception reports showing that certain people are chronically late in fulfilling compliance obligations. Maybe it's personal trade reporting, maybe it's gifts and entertainment reporting, maybe they're not pre-clearing what needs to be pre-cleared. You have to follow up on it. Somebody who hasn't provided a brokerage statement for a firm that doesn't provide online data feeds can't be allowed to slide. That's their problem becoming your problem as a compliance officer. And so you want to be really careful in calibrating your exception reporting. You don't want tunnel vision so that you're failing to pick up easy and obvious peripheral issues, but you don't want to cast the net so widely that it's impossible to review every exception and follow up on the ones that merit follow-up.
Yeah, I think that's exactly right. And I think that this is sort of an easy one, or maybe not easy is not the right word, but this is something that's important that we should have spent the time on already. And so, I think the SEC expects us to have spent the time tailoring our policies and procedures. And so when they're not tailored and when they're not followed, I think, and rightfully so, I think it almost always ends in a deficiency.
Yeah. They look for off-the-shelf policies and procedures. That's a common complaint that's identified in risk alerts regularly. That's an easy one to try to mitigate against.
I agree. Shall we move on to undisclosed conflicts of interest? Maybe Aaron, do you want to take this one?
Yeah, this is a big one. And I mean, under the new administration, they're going to continue to focus on this. This is low-hanging fruit. If you have a conflict of interest, the SEC expects you to disclose it to your clients, full stop. That's part of your duty of loyalty, quite frankly. You cannot not disclose full and material facts so that your clients know and understand what the relationship is about, quite frankly. So this is one that I fully expect the SEC will continue to bring enforcement actions on, even in the new administration.
I agree. And I think it's interesting. I was just doing a training for a client, and in trainings for clients, I feel like I'm always talking about how we need to identify conflicts of interest so that we can try to mitigate them.
Yeah.
And this is one of those things where it's easy, right? Like first we need to know about the potential conflict, and then it's how do we mitigate it, right? And probably one of the easiest ways is through disclosing it.
And that's a regulatory requirement in the ADV Part 2A. If you have certain affiliations and material relationships that pose a conflict of interest, what is the conflict and how do you mitigate against it? You'll see that right in item 10 of Part 2A, for example.
Yeah, I think that's right. And so I guess just maybe moving on to duty of care. Aaron, maybe I'll give you this one as well.
This is an interesting one. Are you acting in the best interest of your clients? Are you charging fees on accounts that have little money in them? Are you charging fees for not performing services? Are you making, quite frankly, stupid investments on behalf of your clients where you're not investing in something that is suitable for them? You're not monitoring accounts. These are some of the common deficiencies we see, and even enforcement actions. The SEC, I found this, and I'd be curious, Karen and Nick, if you saw this last year, and even the year before, but before the administration switched, and I think this might go away, they were testing what I would view as novel duty of care actions. And for example, you set up a warehouse vehicle. That wasn't in the best interest of your client. We actually heard that on an exam, which conflicts with, well-standing industry practice that you are warehousing investments and then taking the appropriate steps to, ensure that you're meeting 2063 related to principal transactions, for example. But duty of care was something that they definitely were pushing the envelope on. And again, saw it on exams, and we heard references to it from SEC officials at various conferences last year. I think that will go away, but curious if either of you saw any of those particular deficiencies or kind of pushing and questioning about duty of care.
Not one I've come across recently. Nick, what about you?
Yeah, I think we see it all the time. And I think it sort of comes back to like the fiduciary duty concept and putting the clients first, right? And I think that there's sort of these two big pillars in compliance generally. And to me, it's like there's conflicts and there's fiduciary duty. And almost everything that we do as a compliance department comes out of those two things. And so, yeah, I think that there was a lot of sort of pushing on, you were doing this, it wasn't in the best interest of your clients, but also along the disclosure lines. Were you disclosing this to your clients? Did they know that they were paying fees for this? Like, they all sort of, those two sort of dovetail together for me, I think.
Yeah, and this was identified in the 2025 priorities document, which you might want to take a look at. And they focused on certain products in particular. So high cost products, unconventional instruments, illiquid or difficult to value assets, assets that are sensitive to higher interest rates. That's the kind of roadmap on duty of care that they publicly identified as being an area that they're really going to focus on. So if you're investing your client's money into any of those products, you can also expect that on an exam, they're going to focus on that and make sure that you are acting in the best interest of your clients in making those investments. Interestingly, last year, they also identified commercial real estate as a new area that they would be focusing on, which I took note of, given the market and how that's been changing. So that's another area where you probably will be seeing duty of care focus.
And so, Aaron, how do you think we could go about mitigating some of these or avoiding getting these deficiencies? Is it better investment memos, really taking that into account, or what are some ways we can think about this?
Making sure that you believe that these are suitable investments for your clients. I think documenting the basis for that, doing due diligence on the investments and taking care, not to use the word, but taking care to make sure that these are actually, in your view, good investments. You're not going to invest in something that's about to go bankrupt, and you have the ability to see that. But I think documenting it is a good way to memorialize what you were thinking and how you went about this, and having a good process in place to show the SEC when they come in always goes a long way.
Yeah, I couldn't agree more. There is nothing that I love more than dropping a memo about something that the SEC is asking for right in their lap and saying, we thought about it. Here's our reasoning for why we did it. And, maybe at the end of the day, they don't agree with the reasoning, but I think that they appreciate that you've at least put thought into it, and it shows that you have processes around things. And I think that goes a long way towards making you look professional and, engaged in their eyes. I think maybe let's move on to marketing. And Karen, have you seen some trends in the marketing space as far as deficiencies go?
Sure, yes. There's an old saying, shooting fish in a barrel is easy. Your marketing materials are the fish in that proverbial barrel. Ever since I got in-house in 1993, marketing review has been an issue. And Up until very recently, testimonials and endorsements have been verboten, completely prohibited, no how, no way. And if you saw a testimonial, there was a pretty safe bet that that was not a first-rate advisor. Now, they're not presumptively fraudulent. And so it's tricky ground for advisors. And what you want to do, if you're even going to set down that road at all, is be very careful whose testimonial you take, whose endorsement you're willing to take, and even recognizing what constitutes an endorsement. If you have a LinkedIn page, for example, for your firm, you might want to turn off the endorsement and recommendations functionality so that you're not widespread advertising to the world what people have said. If it's your page, you own what's there, whether you willingly or even thoughtfully put it there or otherwise. But this is particularly important if you're in the private fund space. Anything in the nature of an endorsement or a testimonial could actually give you a problem invoking the private placement exemption for your next fund or the funds that you are currently marketing. So be particularly careful if you are selling private placements.
And I'll note that where you see this come up in private fund world in particular is anytime you're using a placement agent to help sell the interests in your fund, that's going to be an endorsement in the eyes of the marketing rule. And so you want to be very thoughtful about how you approach the placement agent, the contractual agreement you have with them to ensure that the disclosures under the rule are provided. So that's one thing I would note. And Karen, to your earlier point about the fish in the barrel, I mean, when that initial production request list comes, the SEC asks for your marketing materials, all pitch decks, all communications with clients in some cases. So your marketing materials are absolutely going to be under their microscope.
That's correct. And this is where you have a huge opportunity to protect your firm. You are required to review and sign off on marketing materials before they're used. It's good to be picky. What matters here? I refer to it as the voice of God statements, where your marketing materials assert factual propositions as though they're beyond question. Nothing is beyond question to the staff. Source every factual assertion. If it's not a fact, make very clear when what you are offering is a point of view or an opinion. Another area that they are getting particularly difficult about is adjectives. It's long been the case that superlatives have been understood to be inappropriate. Nobody can claim in their materials to be the best at anything. So that's easy. We're not the greatest, we're not the best, we're not the only ones. However, what I began seeing in recent years was challenging subjective adjectives. Any adjective is almost by definition subjective. So when you see adjectives in your marketing materials, for an example, we have a highly experienced investment team. Highly experienced is subjective. Who says? Who thinks they're highly experienced? Go with facts. Our core investment team has worked together for X number of years, or the 8 members of our core investment team have in the aggregate however many years of experience. That's objective, it's verifiable. If they come in and give you a hard time about it, you can point to concrete facts in support of what you have said about your team. So be very careful about adjectives of any sort and substantiate everything.
And there's one particular comment that they are always providing because you can't substantiate it in their view. And that's if you say you're conflicts free, you're providing conflict free advice, you have no conflicts of interest. They go after that every time they see it. And you would be amazed at how many people try to put that language into marketing materials. It's very common.
Yeah, and actually, Karen, to your point about saying that you've worked together for X amount of years, I actually had a client who got just a very long list of substantiate this, substantiate this, substantiate this in a request. And one of them was a claim that it was like the 4 top people had, I think they said had 30 years experience working together. And like the SEC went onto their LinkedIns and counted like 29 years or 28 years. And like ask them to prove it. So I guess, I mean, only to say that they are looking at this, they are asking people to substantiate things that you would not expect. And then Aaron, to your point earlier on placement agents being endorsements, another way we see them come to that is it's item, I think 5L on part 1, where it asks about marketing questions. And if you have placement agents in your 7B1 for your private funds, you should have that question marked yes, because we have seen them bring that up in exams.
I will say another area in marketing that we aren't really covering here, but it's been a saga to say the least, is performance. And in particular, individual investments and whether you show net alongside gross. The SEC, in case you had not heard, seems to be backing away from an FAQ they issued back in early 2023, requiring net at the individual investment level. And we think they're going to be publishing guidance more officially sometime in the coming weeks that gives you an ability to just show gross, provided you're also going to be showing the total fund track record. They previewed this at a recent conference. So keep an eye out for that. That could change the way you're presenting your performance. But that was a common deficiency across 2023 and even into 2024 for those that were not coming into compliance with that FAQ. There is some relief on the way, it seems.
I think we would all be relieved to get it.
Yeah, that's a really important point. It's how you go about implementing it. Do not stop gathering the data, allowing you to show net as well as gross. Administrations come and go. And as long as you advertise the performance of a fund, even if that performance goes back beyond the books and records rule of 5 or 7 years or whatever it may be, class by class, please do not forget that clock doesn't even start to run until you stop advertising the performance, and then you've got to keep all those records. Net and gross has come and gone in different iterations over the last 40 some odd years that I've been kicking around financial services. What never changes, though, is they're always going to look, and if they see one thing they have a question about, they will start pulling at that thread and pulling and pulling and pulling. And it can go back a lot of years. So how you show the performance in your marketing materials and what substantiation you keep over time may not always be the same, but always substantiate to the high water mark, not the lower watermark.
Yeah, I agree. And I think as somebody who loves marketing, I think that we should maybe keep moving down our list because we do have quite a few more of these. So maybe Karen, do you want to kick us off talking about some of the code of ethics reporting deficiencies we see?
Sure. Boy, and these are just those hardy perennials. They come back year after year after year, and they're low-hanging fruit. If you have a policy that says no trading without pre-clearance, you'd better have the monitoring in place to look at all that trading. And that's when we come back to what I mentioned about missing paper statements. If you say you're going to review trading and you are required to review trading, have the data. And it doesn't matter whether it's the top person in the firm who's missed a quarterly statement. You have to follow through until you get it. And the time to think about how you discipline a failure to pre-clear is before you have that failure to pre-clear. Because when the day comes that you've got to tackle a big producer or some other executive in the firm who hasn't submitted a paper statement, you don't want to be scrambling on that day trying to figure out what your options are. Even if the initial response to the first failure is a written warning, you have to have something in mind and you have to do it. No one is too big to escape that.
And I think a key point there is I have always found that if you give more severe penalties, the more senior someone is, it does show the SEC that how seriously you take it. So you want to kind of have the penalty or the disciplinary action reflect to some degree the seniority of the person. Now that's hard to do. It is hard to discipline someone who is very senior, but it's important not to shrug it off.
It is, and I would suggest that those of you compliance officers who are also lawyers need to be thinking about what your ethical obligations are if, no matter what you do, a senior official at your firm who appears untouchable says, sorry, I can't be bothered. If your firm has a board of directors, you are lucky, because you then get to take the extremely difficult step of getting in touch with your board of directors. And that's if the HR person, should you have one, is unable to help. I think most managers are led by ethical people who want to do the right thing. So I have to believe that 9 times out of 10, if you go to someone, not as a cop, but as a coach, to say, hey, listen, we have an issue here. I'm still looking for that piece of paper. You haven't brought it. And how do I deal with anybody else in the firm if I can't even count on you to do the right thing? I really need your support here. If you're enlisting them in your cause, you have a pretty good shot. You know,
I think that's interesting. I think the seniority point is interesting. And it ties in well to, I think, the recidivism point, where if somebody, keeps pre-clearing trades keeps trading without pre-clearing the trades, we would expect to see consequences. And I think the SEC would expect to see consequences get worse for that person. And there's nothing worse than when you have to tell the SEC that the same person is late with their quarterly attestations every quarter, right? It just makes us look very sloppy. And
it's tricky too, because there's a human element here. People don't like showing their financial information to other people. And this kind of ties into identifying access persons. which, those are the people you're going to have to collect this information for in terms of the statements and reports. It gets really tricky. And I'd be curious, Karen and Nick, what you've seen here. It gets really tricky when you start to have people that are senior advisors or people who technically are outside your firm or with another entity that then maybe sit on an investment committee or sit on a board, and they have access to information. Yeah. That's where I think it can get really tricky, because it's very hard to get people in those situations to want to turn over their financials, but they might be access persons under the plain text of the rule. So curious if you've seen that recently.
I've actually dealt with this very recently, and it really becomes a facts and circumstances analysis, right? Of like what information they're getting. Are they sitting through entire investment committee meetings? If so, like probably an access person, right? And once you come to that determination, I think it's very hard to try to ring fence them out of providing those types of statements. And it's not always the best conversation to have. But I think it is one it's to your point, Aaron, unavoidable.
Yeah.
Tough, but you have to do it. And by the way, for those of you chief compliance officers who are lawyers, I've never, as a compliance officer who is also a lawyer, had to butt heads that hard with someone senior. But I have heard anecdotally of people who have resigned because they were simply unable to get the top person to do what they have to do. I would hope that those people, before they resigned, went in and had a real heart-to-heart with that person to say, look, I am up against a wall here. I have a job. I have a legal obligation under the compliance rule to make sure you do this. I also have ethical obligations as a lawyer, even though I don't play one in this role. I cannot keep helping this firm if you can't help me help the firm. That, I would think, should get their attention in a meaningful way, letting them know that resignation is a definite possible outcome. And by the way, if they're willing to take you up on that, then I encourage you to resign, because you will then become part of the problem if you decide that you can live with that.
Yeah. So being mindful of time, do we want to run through the final points?
Yeah, I think we should, probably as quickly as possible. And any questions that I think we're probably not going to be able to get to, we can follow up with you after this presentation to try to answer your questions. But I agree, Aaron. Do you maybe want to take some of these research and controls around MMPI topics?
MMPI is a perennial area of interest for the SEC. It's kind of almost the bedrock of the securities laws, quite frankly. And do you have policies and procedures designed to prevent the misuse of MMPI? And there are certain areas that we've identified on here that the SEC has focused on. Do you have someone who sits on a public company board? Are your employees meeting with public companies in a way where they might come across information that is problematic, could impute the advisor with that MMPI? Are you doing these dinners where you're sharing information? How are you diligencing underlying portfolio companies? Are you coming across information there? So those are areas where you want to have policies and procedures in place, and you want to follow them. There have been enforcement actions on this pretty regularly, so it is an area of focus.
Yeah, I agree. And I think that this is sort of one of those perennial things that, is going to keep coming up. And just MMPI to me is sort of the third rail of compliance. Anything having to do with insider trading is extremely scary. And even just, being associated with it could be very detrimental to the reputation of a firm. So I think this is something that we really need to take seriously. I don't
And
know if any.
the penalties can be catastrophic. The monetary penalties, the jail time, the industry bars. I'm not saying that to scare people, but that is the reality of one of those violations.
Yeah, agreed. Do we want to talk about custody of client assets for a little bit? Maybe Aaron, I'll let you start on this one.
Another perennial focus. Are you getting the audits for private funds? Are you delivering financial statements within 120 days of a fiscal year end? Are you getting a surprise exam for an SMA? These are easy ones for the SEC. If you don't get them, they're going to bring an enforcement action in all likelihood. There's one recent item on ADV disclosures where they brought enforcement actions against a whole group of advisors who weren't properly checking the box on their Form ADV, which I personally thought was ridiculous. I'm not sure if either of you had a view on that, but that to me was regulatory overstep.
Yeah, there would probably have been a little more to that than what met the public eye in the enforcement action. Seems a little extreme.
I agree that that's a little bit extreme. And I'm just, trying to be a little bit cognizant of time. So maybe let's, should we move on to valuation? And Karen, do you maybe want to take this one?
Sure. So if you're doing stocks and bonds in your portfolios, valuation's going to be fine. There's publicly available, transparent information. The risks really, to my thinking, come up most in illiquids of one or another sort. If you are trading private placement securities, then there isn't a daily trade tape to follow. And here, my advice would be get an outside data source to provide you information. You may want to touch base with your portfolio managers and ask for market color, but it is a fine line between getting market color and allowing them to influence your decision making. Valuation really needs to be independent from portfolio management. Another fine point to watch, market color that causes you maybe to downmark something from the data feed you're getting from an outside valuation source is less risky than where market color is letting you raise a valuation. Anytime you value an instrument more highly than the number you get from a third party, the staff will be looking to see whether that was the difference between getting an incentive fee or not getting an incentive fee, getting a higher fee or getting a lower fee. So that's the tension that you always have to keep in mind when you value illiquids, and recognizing that market manipulation can push down as well as push up. It's really only the upward adjustments that dovetail with the fee issues and the fiduciary duty issues that the staff is really going to be looking for in your valuations.
And Karen, I can't tell you how many exams in the last year I've dealt with for private equity firms. And most of these are firms who are like, new advisors, and maybe they have one position. And the SEC comes in, they see that they were valued by a third party. The third party gave them a range of valuations. They took something towards the top of the range. And the SEC just keeps asking them to prove that and to justify why they took that band of the valuation. I must have seen it 3 times in like the last year, and that was like kind of the sole basis for extending exams. So I think that's, and they're doing everything right. They got a third party valuation, and so I found that very interesting lately. I know that we are about to end. If we maybe, Karen, very quickly want to talk about extension of a fund's term for illiquid assets.
Yeah, Aaron, I thought that one was going to be
Yeah,
yours.
I mean, this one is easy. It speaks for itself. It's basically keeping an investor locked into a vehicle without their consent perpetually in theory. So that one's pretty easy. I think that's just a standard. You've got to get consent to extend the term of a fund as a general matter in the eyes of the SEC.
Yeah, I think that exactly right and very easy. And with that, we just want to thank everybody for attending. I know that we didn't really have time for questions, but I think that these are very interesting topics. And I want to thank you, Aaron and Karen, for a very interesting conversation, for being able to add so much color to, sort of the common deficiencies that we see. And I think with that, thank you everybody for attending. And we will see you next time for what ERAs need to know in 2025 and why AML is on the radar.
Thank you.
Thank you.